Hello and welcome. I'm Siddharth Zarabi and you're watching Business Today. 3 years of COVID, of lockdowns and economic lethargy. The good news now is that this Diwali, just around a month from now, hopefully we'll see the Indian economy fully and finally breaking free of the COVID shackles. The auspicious Navratri season starts this coming Monday and it promises a time of much greater economic activity, of people going out into the markets, big ticket purchases and also fresh investments, equity, mutual fund, gold, whatever that may be. What we have for you today is a really special show on all money matters to help you make the smartest investment calls and to help you grow your money in Samvat 2079.
The Great Indian Sale is back. Great offers, deep discounts, millions of products, all tempting you to spend and bring the mojo back into the Indian economy to end the darkness brought in by COVID. Offline retailers are waiting as well for the inauspicious Shraddh period to end and for the Navratra to begin, for the 9 days of shopping frenzy which will bring back joy into the Indian retail sector. A survey shows just how gung-ho about this festival season Indians are. 65% of households are set to loosen their purses this festive season. 33% of households are likely to spend more than 10,000 rupees. 20% of those polled said that they will spend on big-ticket items. Of this, the maximum spend will be on gadgets, white goods, jewelry or automobiles. There's a 20% rise in shoppers who will visit the market as compared to last year. Budgets are no longer the top criteria for shoppers as during COVID. Overall, the survey estimates that festival spending this year could exceed $32 billion. Nothing shows the rebound from COVID better than the stock market. From a despairing low of 27,591 in March 2020, the Sensex has roared back by 111% to close at 58,099 today. Foreign investors are back in play after a few months' absence earlier this year. The real estate sector, which has gone through tough times in the past few years, is back with a bang. According to a report, the residential sector has recorded a 9-year high sales volume in the first half of this calendar year. There's also good news for those who want to buy gold. Thanks to skyrocketing global interest rates, gold has touched a 7-month low this week, something of an opportunity for buyers of the yellow metal. Bureau Report, Business Today.
And on the show with me today, Ajay Srivastav, CEO of Dimensions Consulting, Feroz Aziz, Deputy CEO at Anand Rathi Wealth Management, and Sugandha Sachdeva, Vice President Commodity and Currency Research at Religare Broking. Thank you very much for joining us. I'm starting with you, Ajay. Very clearly, the equity markets, if we were to compare them with 6 months ago or a year ago, there's a very different flavor despite what's happening globally, despite the increase in interest rates and the consequent impact on market sentiment. How do you see the broader equity theme playing out in the coming Samvat?
See, it's very simple. For next year, equity is perhaps going to be a second-tier investment opportunity compared to fixed income. The interest rates, which are going to go up and will go up much more in the next 3 to 4 months, will give investors the first time an option to go in back to the days when they were getting 12%, 13% on NCDs of NBFCs and companies, or at least 8 to 9% on fixed deposits. So you will find that for the next 12 to 18 months, this will become a very good opportunity for investors for this summer to lock into high interest rate instruments which they have been waiting for the last 6-7 years, because interest rate in India, the way they are, it's actually negative for most savers because inflation is higher than them. If the RBI, and I think RBI will have to take a stance to take up the rates fast, I think you need to keep your powder dry, keep your money on the side, because the opportunities you're going to get to go into fixed income instruments are going to be one of a kind, and they will give you returns for next 4 to 5 years. I believe that at 12% odd return that you get on fixed income, you are definitely in a much in favor compared to equity investment in the current scenario at current valuation. Indian valuation not cheap. Economy is what it is. Global economy is, you all been hearing about interest rate hike in the US. So I would say keep your powder dry, focus on either investment trust, REITs, or fixed income at this point of time, and keep equity allocations for those days when you see severe corrections. You don't need to be chasing a rally or chasing stocks which think have gone beyond. Focus on fixed income. This is the year for fixed income.
Sound conservative advice. Feroz, do you agree with that? And the reason I say this, the US Fed is playing a spoiler in some ways when it comes to the market party.
Siddharth Bhai, I think I would not concur with Ajay sir. Because on the debt side, my personal belief is that anybody who would give me 12% would have an immense amount of credit risk. And we have seen 6 AAA companies in the last couple of years, especially after the ILFS crisis in the mutual fund fraternity, AAA companies going bankrupt. So anybody whose borrowing cost is double digits, in spite of another 1-2% increase in the repo rate, I would see is skating on thin ice. Because if I borrow at 12 as an NBFC, I'll have to create a NIM of 2-3% and lend to people at 15%, and the delinquency rates there are so high. Today you see a lot of peer-to-peer lending platforms who are making 9% NIM by lending at 20%. The delinquency rates in such an economic volatile environment could be very high, and that's a risk on capital. That's point one. Point two, from an equity standpoint, if you look at the kind of growth we have seen in corporate earnings, 518 was the Nifty earnings in FY21. In FY22, we came to 720, which is a good 43-44% growth on Nifty earnings. On the back of that, we are looking at an 870 number for this year. If 870 is the Nifty's earning per share, 17,000 is just 19 PE. I personally think in an environment where we have outperformed the globe significantly, if the MSCI, which is the Morgan Stanley Emerging Market Index, increases the India weightage, the foreign money has to come back at higher levels than they sold. So I personally think a one-year time correction, which is what we saw from the last Samvat to this Samvat, is a reasonable time correction with another 3-4% correction, is great opportunity for people to invest, especially given the fact that the Indian domestic money has become 12,000 crores a month. Retail money, the lower end of the pyramid is giving 12,000 crores of retail money per month. That's expected to go to 25,000 crores in the next 3-4 years, and it's writing on the wall. So we're going to be an Atmanirbhar equity capital market.
Right.
So in that, I'm not saying Nifty will double, but at least Nifty giving you a double-digit return over a 4-5 year period holding, I think is a reasonable high probability.
Okay, so two different perspectives on what I call save, invest, prosper. That is the actual SIP mantra according to me. And before I let Ajay sort of answer, I have to go to Sugandha. Equities, mutual fund, fixed instruments, riskier exposures, leave that aside. India and its fascination with gold. It's never going to go away. How is gold looking like as an investment opportunity in the year ahead?
Yeah, hi Siddharth. A very good evening to you and all the viewers. It's a pleasure to be here. Talking about gold at the time of festival season, obviously Indians have a lot of affinity for gold and it's a time-tested asset. I think every time is a perfect time to buy gold, and gold basically offers safety to your portfolio. It's actually a diversification tool. So we cannot say whether buy gold or not. I think gold should be a part of every portfolio. Be it your allocation can be increased or decreased depending on the macroeconomic scenario. So if I talk about this year, I think the ride has been pretty bumpy. So at one point in time, we prices soared to a level of around 55,500 and levels of close to 2070 per ounce in international markets.
Yes.
But then after that, there has been a downward drift we have seen in prices. And for the last 6 months, in the international market, prices are trading on the lower trajectory. But the domestic scenario is totally different, and we are seeing a totally divergent scenario in the domestic market, wherein prices are down slightly, but then the rupee factor is providing a lot of cushion to gold prices at the moment. In spite of the fact that liquidity conditions are tightening, it's an environment of rising interest rates, which is actually playing a spoil sport and actually weighing on the gold prices, with greenback heading towards a fresh 20-year highs today as well. So all of these factors are certainly suppressing gold prices at the moment. But then I feel towards the last quarter of this year, demand is again going to be very healthy, as we have normally seen in the last quarter of every year, that demand picks up because of the wedding season as well as the festive season.
Sugandha,
as to if the prices are trading at a significant discount to the record highs of around 56,000, that's a perfect time to buy gold.
Right.
I would not stick my neck out and say that yes, prices are bottomed out, but yes, there can be some more pain in prices of around 2 to 3% from these levels, but then it's certainly a level that you can start accumulating gold in a staggered manner. So at one level, if I talk about 48,800 is a good accumulation zone for gold. If we breach that level, yes, there can be some more pain in gold prices, but then if you look at a longer term perspective, if we talk about next Samvat and next Diwali, I think the outlook is fairly positive. It's basically the environment of rising inflation, which is...
Let me hold you there, Sugandha. Let me hold your thoughts there, because we'll end up covering a lot of ground in the time that is left. Ajay, I'm coming back to you on the broader point, which is the difference in view and your call. Let me ask you about two things with regard to the Indian equity market. Stretched valuations, but that is something that we have been hearing for a lot of time, and there are individual stocks which make your eyes pop out and you would question fundamentals. Yet, as far as inflation is concerned, I would argue that in the Indian environment, the pressure on the monetary authority and the fiscal authority is to continue to support growth. We cannot be a solely inflation chasing warrior like the US Fed. What impact does that have on equity, Ajay?
See, it's very simple. If RBI was sitting in an island, yes, there was no, you could do what you choose to do, and they did it. Actually, they've done it in the last 6-7 months. The Federal Reserve and everybody else has increased rates much faster than the Indian RBI. But now we reached a point where the difference between Fed interest rate and Indian interest rate bank rate is not 2.3%, and therefore rupee at dollar at 81 rupees. If you need to get flows in this country, if you need to have a currency which is at par, or you'll keep losing your reserve at the end of the day, you need to take your interest rate up so that the parity between Indian interest rate and the US interest rates comes back to the last 10-20 year average, which is about 1.5 to 2% more.
Okay.
So, even RBI is now did what it did, for whatever reason it did, but even like Fed Reserve realized that they were behind the curve, but they were much better than Indian RBI. We will see in the Indian policy, RBI will have to fast forward the interest rate, because now, given what's happened to the Bank of England, increase the rates, what happened in the US, what's happening everywhere, you have no choice. That's why the rupee you saw at 81. If India does not increase interest rates in parity with America, the dollar will become 83, 84, 85 in quick order, which has own series of implications on Indian economy. Therefore, I believe that RBI will do what every central bank has done, move the rates up. And as I think my colleague also said, when you talk about equity, 4% correction is a good point to come in here. Yes, absolutely. If market corrects by 5 to 6%, it's a good time to come in here, but you lose a lot of money. And on the point of default, just to assure most people that 90% of Indian investors who invest in bonds and this thing get their money back. ILFS was a story, leave it aside. But the fact is, if you invested in a Paytm, your money would be half in less on the day it got listed. So it's not that equity will give you only returns, and we have seen the returns have been muted in the last 2 years on equity, and mutual fund returns are in single digits now. So at the end of the day, we have lived in an environment of 6%, so we love the mutual fund return of 8%. That's going to change, gentlemen, changing and going to change fast.
Time for a quick break. Stay with us. Welcome back. You're watching our special show. We also have some data of a survey that's been done and that asked the question to a lot of respondents, where will they be spending on this festive season? And the answers are sort of evenly spread out, but I'll just sort of take them up here. Puja, Diwali supplies, 35% of the respondents seem to be suggesting that they'll spend for that. Festival groceries, another 26% home renovation 13%, beauty fashion 12%, smartphones, electronics, white good appliances at 6%, and automobiles finally at just 4%. Coming to you, Feroz, and this is to focus on SIP by SIP. What are the SIPs that we should be looking at in terms of the current macro environment, and as I always argue, for long-term investors without the greed factor and therefore consequently lesser fear as well?
Great. So I think, like Ajay said, if you buy a single stock, you could lose half your money. So in mutual funds, I would recommend 5 different mutual funds for this Samvat. 5 ones which can be complementary to each other. So one of them would be SBI Contra. That's first one. Kotak Emerging Equities. Then you can look at Invesco Multi-Cap Fund, ICICI Focused Equity, and lastly a large cap fund which is Franklin Blue Chip. So if you look at these 5 funds, if you're buying these 5 funds for 1,000 rupees each or even 500 rupees each, you're going to have 160 stocks in your portfolio. Now all of them are not going to go down in a jiffy, right? So point is this: if you consistently invest, making double-digit returns with the tax efficiency which equity provides, unlike debt, is very, very likely. Of course, it's not going to be a linear curve. Anytime when the market falls, you have to look at data. There are 31 funds, equity funds, which have finished 25 years in India. If somebody were to invest for 10 big years, the unluckiest investor has not lost capital.
Okay.
So,
and Lady Luck has a major role to play, Feroz, and like you and Ajay Srivastav have been observing the markets for decades, luck certainly is a key factor. I'm coming to you, Sugandha, on a quick answer really in terms of allocations. Now for the average investor and not for the sophisticated investor, if you can quickly explain how much should gold be part of a standard portfolio?
So I think, Siddharth, a standard portfolio should ideally contain 10 to 15% allocation into gold. So it could be in various
And what kind of gold?
Be it you buy gold bonds, which also offer the additional benefit of 2.5% annualized interest, or you may buy gold ETFs, which offer significant liquidity, or you can even do SIPs in gold mutual funds. So you have various avenues. This is separate from your consumption perspective. For consumption perspective, you can certainly buy jewelry because they give you touch and feel and also are a good option to invest. But otherwise, if you're looking solely at investment perspective, I think these 3 avenues are very good to invest into gold, and your allocation should be 10 to 15%. But yes, with the concerns surrounding global economy, there are a lot of concerns about slowdown, recession fears, rising inflation, and geopolitical risk are still there. So I think allocation can even be increased to 20%. But yes, it all depends on your investment objectives, your goals, and your risk appetite. But then I would certainly say 10% is the bare minimum that you should ideally invest in gold.
Ajay, let's talk about the global risk factors. We know the US Fed is responsible for a lot of the sentiment change and what's happening in the markets. The United States followed for, actually, if you look at it in a different way, for the last 1.5 decades, a loose monetary policy, and they are only pausing because of the fact that Americans of the present generation are seeing such high prices that they have never seen in their lives. And the moment there is a slowdown, a lot of people and analysts say the Fed will lift its foot off the brake. Is that the scenario that we should in India also be expecting with regard to the US environment?
That was so true till, it's amazing that you say that, because it was so true till about 2 weeks back, where the whole world was thinking that they will do exactly what all the central bank did 20 years back, is when the equity markets go down, they came and supported the market. And I think that pivot happened about 2 weeks back when he came up with a speech and said, listen, inflation is the fight, we're going to do it, and irrespective of, and the last speech day for yesterday said, we're going to have this increase and the next increase and the next increase till we get inflation under control below 2%, which is their target rate. I think the paradigm has changed. Not only interest rate, now what's the bigger problem which we are seeing now is not the interest rate alone, but the fact is the shrinking of the balance sheet. As per Federal Reserve, the balance sheet has to now shrink by $85 billion on every monthly basis. That's the big one. Liquidity goes out. And we have all seen the reason for big liquidity was the insane valuations for the startups, turnover of 400 crore, loss of 600 crore, valuation of $10 billion. That's what the reality of the market was. Chala do, equity wala chala do. Kyun bhai, 400 crore, 400 crore ka turnover hai, 400 crore loss. So every time I sell you a good rupees of 1 rupee, I said take 1 rupee more apart from the goods. That was, and it was rewarded by a valuation of $10 billion. Now that has still not gone out of the system. That needs to go out. But the fact remains that I think all central banks around the world have now taken a clear stance on inflation. And that's why we say India has been an outlier, actually, Indian Central Bank, which supported growth over inflation, but now having 3 quarters, and they need to report to the parliament now as to how they failed and what's happening in the US. I think they've run out of choices. The RBI governor did what he had to do for the growth versus inflation. Now I think we'll see in this policy the moving to inflation versus growth, because even that you see today, even today for all the good things,
right,
the India's car sales today, even today, are lower than 2019. That's the answer to the thing that has the recovery happened. So yes, the richer people, there's recovery on 5-star hotels, so hotels are doing well, the premium cars are doing well. But the bottom 70% of the people of the country have a problem of inflation, and which the RBI will have to account for it. And that's why we said that exuberance for the first, and number 2, the savers of Indian savers. Can you imagine that pensioners are actually losing 4 to 5% of their corpus every year because of inflation versus interest rate, and which is showing up in the consumption. It's not that it's not showing up, it's showing up in the poor consumption today. And therefore, I think we will see addressal of these issues down the path, and which is why he said that when the time comes, most people have equity portfolios. It's not this versus that, equity versus debt, but this is a time to load up high benefits of debt rather than loading up more equity.
Feroz, just one quick point when it comes to the outlook and the expectation that investors have. You know that a lot of time individual greed feeds into oversized expectations, and the point that Ajay made, for the last 2 years, even if you were a casual participant in any form of investment in the Indian market, you would have believed that outside returns are the norm. We have seen literally millions of people coming into the markets directly and indirectly. What kind of expectations tempering should the average Indian investor have in the months and year ahead?
Siddharthji, there are 2 different kinds of strata of people. One is the retail, the other is the HNI. If I look at retail, which is now contributing significantly to the Indian capital market, I personally think their expectations are reasonably tapered this time around, because this whole now, for example, last 1 year we've gone nowhere. October last year we touched 18,600 on Nifty on an intraday basis, 18,500 on a closing basis. In spite of that, you see the highest SIP number coming after a year of 12,120. So point I'm trying to make is, from 2013, when SEBI actually mandated investor education with a portion of expense from the mutual fund kitty, we have spent 3,000-4,000 crores on investor education. So greed has not propelled this money. More so the education has propelled this money. That's point 1. I think last 1 year has seasoned the expectation of HNIs as well, because they burned fingers not just on equity side. Like Ajayji mentioned, people were buying unlisted stocks of technology, hoping that they will be able to catch an Amazon before listing. I think those dreams have got shattered. So there's some degree of rap on the knuckles for people. So I think HNI's expectations are tapered marginally. But I think anybody who invests in equity should realize that making 10-12% on Nifty is what should be the expectation. A great fund manager should add you 2% compounded return more. If that's your expectation, with a clear consciousness that every year market for the last 21 years have fallen 14.3% average every single year. As long as you can weather the storm, that's when you deserve 2-3 times more than an FD return.
Okay. Sugandha, very quickly as we wind down the show, one of the points that I want you to quickly talk about, and this is a risk factor, which is the fact that when it comes to our headline inflation numbers, a pass-through is not happening. And I'm referring to petrol and diesel price increases, which have not happened for several months now. My fear in the current environment, and maybe a month later we could be discussing something completely different, is that when that pass-through happens, even in a staggered fashion, it will put further pressure as far as the headline inflation number is concerned. Do you agree with that?
Yeah, it is certainly a possibility, because I think I spoke about this point, geopolitical risks are still there. So in case the crisis, the Russia-Ukraine crisis escalates further, there could be further energy crisis, and we could again see crude prices soaring higher. We have already seen crude prices have been weakening over the past several weeks, but then there is still an element of fear there, because we are still hearing a lot of news that there could be potential escalation in the Russia-Ukraine crisis. So in case that happens, and with the winter season coming in, there could be a lot of gas to oil switching also. So that could also lead to increased prices of crude oil. So I see crude prices, they could be bottoming out at levels of around $78 to $75 per barrel for Brent crude. So from there on, there can be increased demand for crude oil prices, and that could actually lead to a pass-on effect in the domestic petrol prices, and that could actually lead to inflation significantly soaring higher. India has been performing well in terms of we have been able to control our inflation, but then if we look at the developed world, inflation is at multi-decade high. So I think that factor will certainly play out, and I think we cannot stay isolated for a very long time.
Right.
So it will certainly have an impact on gold prices as well.
Cannot stay isolated, and we have to be cautious of what is not just happening in India, but overseas as well. Ajay, Feroz and Sugandha, thank you very much for your time. And
thank you very much.
Leave you today, I'll just repeat that mantra: save, invest and prosper, but with caution and with extremely low amounts of greed. Have a good Samvat. Thank you and bye-bye.